Welcome to this explainer on Gamehouse's Q2 2026 financial results. In the incredibly fast-paced world of mobile gaming, the playbook is almost always about relentless, expensive growth. It's usually about getting as many eyeballs on your games as humanly possible, pretty much no matter the cost. But Gamehouse's latest report, it's completely contradictory to that trend. And honestly, it's contradictory in the best way possible. It turns out, actually shrinking certain parts of your business might be exactly what you need to do to watch your profits absolutely soar. Let's dive in and see exactly how they pulled this off.
Right out of the gate, we're hit with a massive curveball. Gamehaus reported a top-line revenue drop of 7.8%, falling down to $26.3 million. Now, in a vacuum, a revenue drop like that usually sets off major alarm bells for investors, right? But here's the crazy part. Somehow, their net income didn't just survive the drop, it absolutely exploded. We are talking about a surge of over 150%, jumping from roughly $400,000 to nearly $1 million. So this creates an immediate paradox, doesn't it? It forces us to ask a really counterintuitive question. How exactly can a tech company shrink its top-line revenue, seemingly lose ground in the market, but at the exact same time massively grow its bottom-line profits? I mean, it completely flips the whole growth-at-all-costs tech narrative right on its head. To understand the mechanics behind this impressive magic trick, we have to look past the dollar signs for a second and examine the actual people playing these games. The mystery actually deepens when we look at their user base. Over the last year, Gamehaus lost hundreds of thousands of active players. Daily users plummeted from over 700,000 down to under 500,000. And their monthly users took a huge hit too, dropping from nearly 4 million to well under 3 million. On paper, losing a third of your daily player base sounds like an absolute crisis. But remember that massive profit spike we just talked about? To crack this code, we really need to zero in on a specific metric called ARPDAU. That's average revenue per daily active user. This metric is literally the lifeblood of mobile game monetization because it reveals the true financial quality of your audience rather than just the sheer quantity of people tapping on a screen. And this metric brilliantly illustrates the turnaround. Despite having a significantly smaller player base, Gamehaus's ARPDAU jumped from 44 cents all the way up to over 56 cents. Now that might sound like small change, but in the mobile gaming space, where margins are often measured in fractions of a cent, that is a massive, massive leap. What this essentially tells us is that the players who left, they were likely casual free-to-play users who just weren't contributing to the bottom line anyway. The smaller player base that actually stuck around is spending significantly more money per person. And the data backs this up even further. Their daily payer conversion rate jumped from 2.1% to 2.5%. This is absolute proof that while they have fewer players overall, the audience they've retained is highly concentrated with lucrative, paying customers. They've essentially trimmed the fat from their ecosystem, leaving only the most dedicated and profitable players. But that begs the question, how exactly did they orchestrate this audience shift without accidentally destroying the company in the process?
Well, they didn't just get lucky here. They practically took a chainsaw to their expenses. They strategically slashed their user acquisition and marketing budgets by a whopping 18.4%. You see, in the past, they might have spent heavily on ads to bring in millions of those casual users. But let's be real for a second. Navigating the absurdity of today's volatile mobile ad market is completely exhausting. So instead of buying expensive, low-converting ad traffic, they simply stopped. And at the same time, they successfully negotiated lower platform fees and reduced their profit-sharing payments. This financial discipline translates directly to the bottom line. Their total operating costs and expenses dropped by over 10%, landing at $25.4 million. That is a $2.9 million reduction in operating costs. And that is the exact mechanism that fueled that 151% profit spike we saw at the very beginning. Put simply, they brought in slightly less revenue, but it cost them drastically less to generate it. But wait, Gamehaus isn't just stuffing this newly found cash under a mattress. While sales and marketing took that steep cut, they're actively redirecting those savings straight into their future. Research and development expenses actually increased by 7.5% as they collaborate with developers on brand new titles. On top of that, general and administrative expenses went up significantly, about 65%, to improve corporate governance and strengthen their management team to really support long-term expansion. Basically, they are cutting the empty calories and investing heavily in muscle. So the absolute most crucial takeaway here is that none of this was an accident caused by a shrinking market. No, this was a highly intentional pivot orchestrated from the very top. As their founder and chairman, Feng Xie, noted, these results reflect the cumulative impact of disciplined adjustments across their cost structure, their user acquisition strategy, and their product portfolio. Gamehaus has consciously decided to just step off the exhausting, expensive treadmill of growth at all costs, and they've opted instead for a highly sustainable, wildly efficient operating model.
So what's next? Well, now that they've proven this ultralean model actually works, they're aggressively applying it to new projects. Gamehouse is currently testing new titles in the highly lucrative RPG and puzzle genres. And, cleverly, they are using AI-driven efficiencies to ensure their platform capabilities stay strong without letting those operating costs balloon right back up. This entire next phase is all about profitable growth, right from day one. You know, if you ever want to know if a company's leadership truly believes their own turnaround hype, just look at what they do with their own stock. Management's confidence in this leaner, highly profitable model is completely cemented by their active share repurchase plan. The board authorized up to $5 million in buybacks, and as of the end of this quarter, they've already put $459,000 to work, buying back roughly 370,000 of their own shares. They are essentially betting on themselves, reducing the outstanding share count and concentrating value for their remaining investors. By successfully trading empty user growth for hyper-efficient monetization, Gamehouse leaves us with one incredibly compelling question to ponder. In an era where user acquisition costs are sky-high and ad platforms are increasingly volatile, is less but better the new winning formula? By focusing almost exclusively on the players who actually pay and ruthlessly cutting the costs of acquiring the ones who don't, Gamehouse has drawn up a blueprint that the entire tech sector might need to start studying closely. Thank you for joining me for this explainer, and I highly encourage you to think about how this profit paradox might apply to the other industries you follow. Catch you next time.